Paper trading feels like practice, but it lies in three specific ways. Here's what it actually teaches.
A paper trade is one simulated transaction placed on real market prices. Same chart you'd see live, same order ticket, same stop loss field, but when you click buy, nothing actually leaves the platform. The trade gets written to a virtual ledger. No order book, no counterparty, no money at risk. That sounds harmless. It isn't. Because here's what happens to most beginners. 3 months on a simulator, virtual balance climbing from 10 grand to 15. They decide they've figured it out, fund a live account, and give the gains back in 2 weeks flat. The simulator wasn't broken. It lied in 3 very specific ways nobody had warned them about. So let's pull this apart. The paper trade itself is the unit, one simulated transaction opened and closed on Euro US dollar or Apple or whatever instrument the simulator supports. Paper trading is the practice. Many of those run over days or weeks. The unit teaches you workflow. The practice validates a system. Same tool, 2 jobs. And the fields on a paper trade are identical to a live one. Instrument, direction, size, order type, stop loss, target, timestamp. That's the whole point. The simulator should not let you cheat on a workflow you'll use live. If your paper trade skips the stop because it's just practice, you're not paper trading, you're playing a game. Both have an expiration date, 2 to 4 weeks. Hold that number. I'll come back to why it expires. First, the mechanism. The part where simulators most misrepresent reality. When you click buy on a live account, the order leaves the broker. It gets internalized. The broker takes the other side itself, that's B-book, or routed externally to a market maker, an exchange, or an ECN to match against resting orders, that's A-book. The price you actually get depends on what's sitting in that book at that microsecond and how fast your order travels. Slippage, partial fills, requotes, all possible, all real. When you click buy on a paper account, the simulator looks up the displayed bid or ask, writes that price into the virtual ledger, and stops. The order never leaves the platform. No book, no counterparty, no latency. The fill is instant at exactly the price you saw on screen. That's fine for learning workflow. It is not fine for predicting live P&L. On a calm market, the gap is microscopic. On a fast news release or a thinly traded pair, the gap is brutal, and your simulator will never show it to you because it can't see the depth of book in the first place. Which brings us to the 3 predictable lies. Lie number 1, better fills than you'll ever get live. Paper fills at the displayed bid-ask, live fills at whatever the order book actually has. A 1% gap open looks profitable on paper and is underwater live before the trade confirmation even prints. That's not a glitch, that's structural. The simulator can't reproduce depth of book behavior because it doesn't have a book. Lie number 2, no emotional consequence. A losing paper trade costs you nothing, so loss aversion reflexes never develop. The trader who calmly takes a 1% paper loss often refuses to close at 1% live and rides it to 5, then 10, then capitulates at 15 with a margin call. That's not bad luck, that's an untrained reflex. Trading is half mechanical, half psychological. The simulator only trains the mechanical half. Lie number 3 is the invisible one, selection bias. Paper traders silently delete trades that felt wrong before the result came in. The live broker keeps every record. Without a journal, your paper P&L drifts upward by self-selection alone. You think you're winning 60%. You're actually winning 45% and quietly forgetting the rest. None of this is an argument against paper trades. It's an argument against treating their P&L as predictive. Use a paper trade to verify your process. Don't use it to forecast your returns. Let's make that concrete with a worked example. You're learning Euro US dollar on the 1-hour chart at a new broker. Price is at 108.40, uptrend on the daily. It pulls back to a prior resistance zone at 108.20 that's flipped to support. A bullish pin bar prints. You take the setup. You place a paper trade. Long 0.01 lots. Entry 1.0822. Stop loss at 1.0805. That's 17 pips of risk. Target 1.0865, which is 43 pips. Risk to reward roughly 1 to 2.5. 2 hours later, price reaches your target and fills. The simulator credits you positive 43 cents. 43 pips, 10 cents a pip, 0.01 lots. Tiny number, real lessons. Here's what you learned. The ticket workflow at this broker. How the stop and target attach to the position. The difference between a market order and a pending order on this platform. That you can recognize a textbook pullback setup in real time. Here's what you did not learn. Whether the live broker would have actually filled you at 1.0822. Likely yes on a calm session, possibly worse during news. And whether you would have held through a 10-pip wiggle against you before the move resolved. That's the question that decides whether your trading account survives the first month. The simulator cannot answer it. Only a live trade can. Quick clarification because these get confused. Paper trading is not backtesting. A backtest applies your rule set to past data, years of history in minutes, statistically powerful, but it's vulnerable to look-ahead bias and overfitting, and it cannot capture discretionary execution, the moment-by-moment judgment calls a real trader makes. A paper trade is forward, placed on a current live feed, held for whatever the trade takes. Statistically weak, you can only place so many a week, but it forces real-time judgment that historical data never can. These are different tools for different jobs. The sequence that actually works. Backtest the rule set on a year of historical data to confirm there's an edge. Paper trade it forward for 2 weeks to confirm you can execute it. Then live trade it small to confirm the psychology holds. Skip the paper phase and you'll find out with real money that strategies which looked profitable in backtest are often unworkable in practice. Now, back to that 2 to 4 week window. Why does paper trading expire? Because past that point, the consequence is still fake and your brain stops updating. Reflexes only sharpen when something's at stake. Month 3 of a simulator teaches you nothing month 2 didn't. So the transition rule. Size your paper account to match the live account you'll fund. If you're going live with $1,000 risking 10 per trade, your paper trade risks 10, not 100 on a fake 100 grand balance. That rehearses the wrong psychology and you'll have to unlearn it. Journal every trade, why you took it, where the stop went, what happened, what you'd do differently. The journal is what makes the practice cumulative instead of forgettable. And paper trade on the broker you'll actually fund. Practicing on TradingView and then funding an MT5 account at a different broker defeats half the value. The interfaces don't match. Real options include TradingView itself, IBKR's TWS paper account, Thinkorswim from Charles Schwab, or MT4 and MT5 demos at Pepperstone, IC Markets, Owanda, IG, or XM. Confirm the data is real-time, not 15-minute delayed. Match the instrument list to what you'll trade live. So, verdict. A paper trade is a real tool. It just has a narrow job. Use it to learn a platform's workflow. Use it to confirm your entry rule actually triggers in the wild. Use it to debug an automated strategy. Don't use it to forecast returns. That's where it lies hardest, and that's the mistake that costs people their first funded account. 2 weeks of paper trading on the broker you'll actually fund, at the size you'll actually trade, journaled honestly, will teach you more than 3 months of simulator vanity ever could. Past 4 weeks, you're not practicing anymore, you're avoiding. Backtest first, paper trade second, go live small third. That's the sequence, and the simulator's job ends at step 2.
Paper trading teaches workflow, not returns. 2 weeks, then go live small. Full breakdown in the description.